Well, it's finally happened. The American oil patch has soured on U.S. President Donald Trump. He came in as a big champion of oil and gas, and his actions since January have not endeared him to oil and gas executives. I'm going to be talking to Ed Hurst, an energy economist with the University of Houston, about that. So, welcome to the interview, Ed.
Thank you, Martin.
Now, one of the things you have talked about ever since during our interviews, ever since Trump came in, is the fact that he's pushed the Saudis and OPEC to lower global oil prices, which is exactly the opposite of what the domestic oil industry wanted.
Exactly. You know, the lower revenue has really now caught up with them. But of course, we knew this. Um, During Trump 1.0, he wanted the price of oil lower than it was during the Obama administration, and he got that. Not counting the pandemic shutdown, but for the rest of the time when it was business as usual, he extracted a lower oil price from OPEC, and that, of course, really hammered the domestic U.S. oil patch.
One of the things that we've been watching here for a number of years now is the point in the energy transition where, global oil demand peaks, and then the low-cost producers in the Middle East decide it's more important to take back market share than to keep prices up for, from their revenue point of view. And Trump seems to be playing right into that narrative.
It certainly looks that way. There's some confounding features of the market right now. Trump has been very vocal about wanting to impose very strict sanctions on Russian exports. But we all know that oil will still get to market some way. India and China really just don't care what Trump thinks. And there are ways of laundering it through the Middle East, if you will, or through the Caspian Sea. Azerbaijan's production is up significantly over what it was when there were no sanctions on anybody in the area. There's a network of pipelines and transit ports across the Caspian. It's really easy to move oil around without anybody paying attention to it.
Okay, so yesterday or the day before, the Dallas Fed brought out its quarterly report, and it was full of criticism of the administration. And one of them, which we shouldn't be surprised about, is frequent changes in energy policy, day-to-day changes almost, stroke of the pen risk. Maybe you can comment on that.
Yes, and so the Dallas Fed surveys producers in the area, general area, Texas, Louisiana, Arkansas, Oklahoma, and this whipsaw approach is finally getting to the producers. They can't plan anything. The Dallas Fed pointed out that most of them enjoyed maybe less than $1 a barrel improvement because of the lower regulatory burdens. That's not enough to make up for a lost $20 a barrel in revenues. Remember, in January, the price of oil was about $82, $83 a barrel. Today, it's somewhere in the $62, $63 a barrel range, WTI. And the costs have gone up primarily because of the tariff war and the increased cost of steel. And when you're drilling these big, long laterals, and Exxon just announced a 4 mile lateral, that costs more money. And so the incremental costs are up 5 to 12% on these wells, while the revenue is down $20 a barrel.
Again, something that you've been talking about for a while is that uh, the shale operation, despite the fact that the U.S. is the world's largest oil producer at about, I think, 13.2 million barrels a day, the fact remains that it requires high prices in order to sustain that production. Break evens are in the $65 to $70 range, and prices at this level simply don't sustain more drilling and more production.
Right. So with the fourth quarter of 24 Dallas Energy Fed survey, 85% of the respondents said they needed a price of oil greater than $70 a barrel to make new investments to drill more. And with this most recent one, which was released a day or so ago, we're looking at expectations for the oil price not getting above $70 a barrel for the next several years.
Ed, as an economist, clear something up for me here. Is it common, or I'll rephrase that. Is it not unusual that a high cost marginal producer leads the industry in production? That seems odd to me.
Well, with the price umbrella that was existing during the Biden administration, it was easy for the U.S. to get to work on this. The shale plays are really well known. The technology for developing them is straightforward. There was very, very little exploration risk. And it's really kind of neat because one of the questions that the Dallas Fed asked was, do you expect shale plays across the world to expand in terms of development? And more than 60, 65, 70% of the respondents said, yeah, the shale plays, the tight oil plays across the world are going to be building and producing more oil. The Saudis were here recruiting in 2014, 2015, 2016 to get the shale technologies over to Saudi Arabia. Still, there are an awful lot of conventional resources available, and goodness, is Venezuela can ever get its act together again and begin producing. I mean, that country holds the world's largest reserves.
One of the interesting things I found about the Fed survey, because I was reading the comments that they posted on their website, is nobody looks out to the long term and thinks, hey, you know what? The International Energy Agency is forecasting peak oil demand in 2029, decline afterwards. Maybe I should be careful about how I invest in my capital. I should worry about, future demand. And nobody ever, they all seem to just assume that demand for oil will grow into the future. Well, what's your take on that?
Well, I don't think Wall Street it perceives it that way. Wall Street's not been advancing money to the oil patch for the last 5 years. It's the worst performing sector in the S&P. Certainly, there's the behavioral aspect. This can't happen to me, as well as the one of what we would call whistling past the graveyard. Um, a lot of oil in the U.S. Is produced by independents, not the majors, not ExxonMobil, not Shell, not not Chevron. And so they're really kind of working this up to the edge. If OPEC nations decide that they're facing a situation where they may have a stranded asset that they can't get to market, they're going to want to produce more to drive the price down. And that makes perfect sense. They can forestall the transition to EVs. They can forestall the transition to solar in some of the developing nations, but they can't stop it.
Yeah, that makes a perfect sense. Okay, so where are we going with this? Like, look out over the next couple of years, the rest of 2025 into 2026 and 27, because that's part of what the Fed survey was about. Expectations for the short term. What's your take on that?
Well, even if we've reached peak demand and we drop from our current 101, 102 million barrels a day across the global market, let's just say we follow the trend down and lose 3% per year. Don't drill any new wells at all. It's still going to be a 90 plus million barrel a day market. That's what we had 10, 12 years ago. There's a lot of opportunity here. And of course, because the demand for oil is price inelastic, if you need that barrel and it's not being produced, the price will jump and we'll have a really quick hit. As we saw earlier in the year when the price bumped a bit up to 75, everybody jumped in and hedged as fast as they could. But right now, there's not going to be a lot of new investment. People are going to stand down from drilling. The oil field services companies have made major layoffs. They're just going to go ahead and produce because, of course, having drilled the well, having fracked it, it's a sunk cost. We'll see a price spike at some point in the future, but maybe not during the Trump administration.
Ed, help me understand something here because I've let's say that we have peak demand, then we'd go back to where demand was 10, 12 years ago, say 90 million barrels a day. We have productive capacity of more than 105 million barrels a day. I think the IEA is saying that by the end of the decade, it'll be something like 114 million barrels a day. Which producers drop out of the market? Which producers are forced out of the market by lower prices?
Well, the high cost producers will be the ones to go, and that'll be the U.S. shale plays. And of course, the IEA estimation that there'll be 114 million barrels of productive capacity, is suspect. If the price stays down, nobody's going to build that productive capacity, so it's not there. One of the things that really happens with oil is when the price goes up, then suddenly oil in the ground becomes worth more, becomes a reserve. When the price goes down, then the reserves diminish because of the feedback loop and the way we calculate reserves. There's a lot of oil that's technically recoverable. It's just at what price. And the Trump administration and OPEC Plus want to have a lower price now for a number of reasons. One of which is helping the U.S. economy along. The other is punishing the Russian war machine.
Gotcha. Ed, appreciate this as always, and we'll have you back in the near future because given the volatility of the oil and gas markets, this story is not going away. So thank you very much for this.
It could change by this afternoon.